Hello, welcome to this PPR Econ video on monetary policy. First thing I need you to do is define monetary policy, please. So hopefully you've got the monetary policy is MI, hopefully you can remember that, or mix. It's the use of interest rates, the money supply, and exchange rates to influence the economy. Okay, in the UK it's just MI, M and I. We use money supply and interest rates to control the economy. In others, it's mix, so exchange rates is used to control the economy as well. In the UK, we've got a floating exchange rate system, so therefore we don't use that or influence the exchange rate to control the economy. Obviously, I'm pretty sure you know that the Bank of England are responsible for monetary policy in the UK, in particular the Monetary Policy Committee. If there was a boom phase, okay, or a recession, see if you can remember what type of monetary policy would be implemented. Okay, so in a boom phase, we would use what's called contractionary monetary policy. Okay, and that's whenever interest rates are put up, we reverse quantitative easing to reduce the money supply and we appreciate the pound. Okay, and if it is a recession, we would use expansionary monetary policy, and that's decreasing interest rates. We would start implementing quantitative easing, which will be explained later, and we would depreciate the currency to boost the economy. Okay, so contractionary is always to boost AD, and contractionary is always to reduce AD. So contractionary, reduce, expansionary, expand AD. See if you can now think of some of the key roles and remits of the Monetary Policy Committee, please. So there's a key term you need to be aware of, and that is acting as a lender of the last resort. That's a big role of the Bank of England, and that is someone who commercial banks, so for example Nationwide, Santander, HSBC, turn to whenever they're very short of funds. Okay, so the Bank of England will step in and provide them with short-term funds to help them on their daily business. And the rate they charge is what we call the base rate, which we'll talk about in a bit. They've got a target, and that is to keep inflation at 2%. Okay, so the Bank of England are independent from the government, but they've been set the task of controlling inflation via their tools at 2%. Okay, in the UK we've got what's called a symmetrical target. Okay, so that target is 2%. It can go up by 1% to 3%. It can go down by 1% to 1%, but it can't go outside that threshold. Okay, so it's allowed to stay inside 1 to 3%, but it can't go outside that. If it does, the governor of the Bank of England has to write an open letter to the chancellor explaining why. And in America, they've got an asymmetric target. Okay, so they've got a target of 2% for inflation, but it's asymmetric in the sense that it can go up to 2%, but it can't go above 2%. Okay, so that is an asymmetric target. So you need to know the difference between them two. Interest rates, define please. Hopefully you've got the interest rates, so the cost of borrowing and the reward to saving. Okay, so that is a key tool of the Bank of England, who set what's called a base rate. Okay, and a base rate is the Bank of England interest rate, and that is set every month by the members of the Monetary Policy Committee. Transmission mechanism. See if you can remember the process by which monetary policy interest rates inversely affect inflation. So see if you can draw the mechanism starting off with the base rate, and if it goes up, how it ultimately causes inflation to go down. So there's what you should have. The base rate is sometimes called the repo rate, and that feeds right through to affect inflation. So if interest rates, for example, went up, we would assume inflation would go down via this transmission mechanism. So if you didn't do it yet, see if you can draw arrows to show the inverse relationship. So hopefully you've got that. If the base rate goes up, inflation goes down. Base rate goes on to affect market rates in the economy. As I said earlier on, the base rate is charged to commercial banks if they need to lend funds from the central bank. So they will implement the same rate. Asset prices will go down, so that's things like shares, houses. Obviously, if interest rates are higher, you know that interest rates are the cost of borrowing and the reward to saving. So that means they're more expensive to fund, and therefore the demand for them will fall. Expectations and confidence in the economy should go down. It is a contractionary policy. Interest rates will mean there's less consumption and spending in the economy, so expectations should go down. And we'll leave the exchange rates for now. Domestic demand should fall, net external demand should fall because of the three things we previously mentioned. That should cause total demand to decrease, and therefore inflation should fall. And obviously the opposite works as well. Now, I didn't talk about the exchange rate there. See if you can remember what hot money flows is. So this is very important you understand that if the interest rate goes up, the exchange rate should appreciate as well. And that is a process which is called hot money flows. And that's whenever the yield, okay, so the return on savings goes up in a country, investors will move their money there if it's a higher rate than everywhere else, because there's a greater return. And that should increase the demand for that currency, which should push that currency up. And the opposite can happen as well. It's very important you understand that process of hot money flows. Some AO4 for low interest rates. See if you can think of a few. So some critiques of interest rates, or expansionary interest rates, we could say, lowering interest rates, are animal spirits. So if confidence is low, even though interest rates go down, people might not spend more money. That's often linked to what's in bold there, which is called a liquidity trap. So that's whenever lower interest rates fail to increase the AD within the economy. There's also, one of the biggest ones is the fact that commercial interest rates can't go lower than zero. Commercial banks aren't going to reverse what interest rates do and basically reward you to borrow and cost you to save. That doesn't make any sense. Central banks can introduce and have introduced negative interest rates to get commercial banks to lend out more money in the economy. Okay, so central banks can implement them, but commercial banks will never implement them, and that's why there's like a zero lower bound. It can't go lower than zero, so that sort of restricts interest rates. So in 2021, interest rates were 0.1% set by the Bank of England. You know, obviously as an expansionary policy, you can't really go much lower than that. Okay, so that's another critique of interest rates. Quantitative easing, okay, in regards to the money supply, is another tool that the Bank of England can use. So see if you can remember what it is. So quantitative easing is basically another way that the Bank of England can increase lending and borrowing in the economy and ultimately boost AD. Okay, it's basically the same as increasing the money supply, but there's a bit more to it. So see if you can remember the stages, so how quantitative easing works. Okay, so there's quite a few stages. So first thing is that the Bank of England electronically create new money. Okay, so they electronically create new money, and with that they buy what are called government bonds, mostly government bonds, and that's basically like government debt. Okay, that is out there in financial markets. So financial markets can sell that. They've bought it for their own investment purposes, but the Bank of England can buy that from these investment companies then. So they buy these government bonds, which means these commercial banks, okay, have more money. Okay, they've got this money coming in. Okay, and so what they do with that money, and you can jump straight to the end, is they will basically, in essence, look to invest that money in sort of maybe riskier assets, or in shares, or in the debt of other businesses, or bonds in other businesses. Okay, so they basically will use that money to make further investments and increase, I suppose, the supply of money that way, which will boost AD. And also they will obviously use that money to lend out to businesses and consumers as well. Okay, that they'll have more funds available to lend out, so they should ultimately lend more out. So that's one way it can boost AD. The other way is these government bonds have got, like, I suppose, a price associated with them. Okay, and if more are bought, the demand for these government bonds will go up. Okay, so the demand for government bonds go up, and there's normally a fixed, what's called a coupon on it. Okay, so the coupon is how much you get as a return for owning that bond. Now what happens is, as the price goes up, that return in essence, okay, actually gets smaller because it's a fixed rate. So if the price goes up, that return actually gets, as a percentage, is smaller. So in essence, what that does then is that reduces bond yields or interest rates throughout the economy. And what that does then is that obviously as well can help boost AD. Okay, so that should incentivize more borrowing and therefore more spending in the economy. So that is basically quantitative easing. The spec also asks you how the government, or sorry, not the government, the Bank of England can directly intervene to stimulate lending. And there was something up until 2015 called funding for lending. Okay, and basically funding for lending was initially to boost bank lending to households and companies explicitly. Okay, and it was open for business in 2012. The aim of the scheme was to increase bank lending. And how it worked was, in essence, basically the Bank of England was letting commercial banks borrow funds from it cheaply. And basically then the thought process would be that the banks would then pass that form of cheaper loans onto firms and consumers. Okay, so that was called funding for lending, and it basically was lower rates of interest rates from the Bank of England passed through to commercial banks, which could be passed on to consumers and businesses, so they would borrow more and boost the economy that way. Okay, so that is everything monetary policy. If you didn't get all the questions correctly, go through it again there, please, and you can obviously screenshot that as well.